Emerging markets can be a volatile part of the investment universe, with the potential for pronounced share price swings up and down. Carlos Hardenberg from Mobius Investment Trust specialises in emerging markets, and he joins me today to talk about general performance and regulatory pressures on Chinese companies this year. I know emerging markets have had a great run between April 2020 and February 2021, but they've been sort of struggling since. If you look at the MSCI Emerging Markets Index, do you think that sort of performance more recently is linked to COVID setbacks, US dollar strength, or is it something else?
Well, of course I can comment on the index, but I'd rather comment on the fund. So we've actually done really well in that period where the index went nowhere. And simply the reason behind it is, if you pick the right businesses that are also doing well in rather challenging periods. So if you have a strong focus on quality, on execution, on management, on culture, then also in these difficult periods, businesses can do well. And the market is increasingly appreciating the quality and the performance of these businesses. But coming to your question, I think that emerging markets are never in a perfect sweet spot. There are always challenges, whether they are of political nature, macroeconomic nature, global trade, currency-related matters. So there's always some sort of challenge that they have to deal with. And I believe this year, of course, Corona and the pandemic in general has been very, very challenging for the emerging market consumer. Emerging markets are still often misunderstood as a pure consumer play. And that's why I think the market has been skeptical about the health of the consumer in emerging markets. However, we actually are positioned very differently. We are positioning towards technology, innovation, digitalization, themes like Internet of Things, 5G, autonomous driving, and they've actually done really well. Of course, the US dollar is always something to watch very carefully, as interest rates in the US and the strength or weakness of the dollar has an immediate impact on refinancing cost of businesses in emerging markets. But also there we are seeing more and more diversification. So the local currency markets have developed and grown up to a much more mature state. So the pure dependency on the dollar is not that large anymore.
What's your exposure to China and also your view about the regulatory crackdown that we've seen in that country this year?
As I said at the beginning, we've been investing in China extra carefully. And we have radically steered away from regulatory risks, from areas where we felt that regulation could become a larger topic anytime in the future, and instead went down a safer route. We've looked at very, very many investment opportunities in China directly in the A-share market. And it is still difficult, not just because of regulatory risks, but also because of accounting irregularities, because of a lack of transparency. Many businesses still refuse to share openly their business case with outside investors. So generally, data quality is poor. We've mainly gone via the Hong Kong route, businesses that are listed in Hong Kong and are doing business in China. And we've looked at the consumer sector, we've looked at the healthcare sector, invested in the healthcare sector, but an area which is not impacted at all by regulation. And that has been a very, very successful investment. And then there's also, to my mind, the greatest opportunity to participate from the opportunities in China is to go via Korea or Taiwan. You have a lot of branded, reputable, well-managed businesses out of these countries, which are, of course, increasingly building up presence in mainland China. And they bring about better governance, better transparency. Also, from an ESG standpoint, they are far ahead of local businesses in China or locally listed businesses.
So, Carlos Hardenberg from the Mobius Investment Trust, thank you for your time today.
Thank you very much.